Good morning, everyone. My name is John D'Antona. We apologize for the delay. I'm the Director of Marketing here at CAPIS, and we'd like to welcome you to our October monthly research call. CAPIS wants to take the time and the opportunity to thank you all for spending your busy day with us. We hope that you find the following information in today's call insightful and helpful. We appreciate you joining us. In order for us to better serve you, there will be a brief survey at the conclusion of today's call. We'd love it if you could take a minute, fill it out, tell us what we're doing wrong, tell us what we're doing right, and then we'll use those results to help make better calls and product going forward. But before we get started, as always, there is the legalese. The opinions expressed by the featured speakers do not necessarily reflect the views of Capital Institutional Services, CAPIS, any CAPIS ownership, or any CAPIS management not providing said opinions. Any comments and/or information presented within this presentation are for the sole use of investors. Nothing in this presentation should be construed as an offer, invitation, or recommendation to sell, or solicitation of an offer to buy any securities that might be mentioned. And now we want to get started with the call. We have our special guests today, Market Policy Partners. And again, I'd like to make note that John and Brendan will take your questions at the conclusion of their remarks. Please type them into the Q&A portion of your Zoom. I'll be sure to get to them. First, I'd like to introduce John Fagan. From 2014 until September 2018, John was director of the U.S. Treasury Markets Room, and prior to that was a senior macro strategist for Discovery Capital Management, primarily responsible for Asian equity indexes, foreign exchange, and rates markets. John holds an MPA from Harvard's Kennedy School and a JD from Harvard Law School. And Brendan Walsh. From 2006 to the summer of 2018, Brendan was a senior analyst at Discovery Capital Management, covering global financial institutions, and was part of the global macro team focusing on macro data, rates, foreign exchange, and equity indices. Brendan holds an MA from Fordham University in International Political Economy and Development and was an international travel fellow to Manila, Philippines in 2004, working on econometric forecasting models. Gentlemen, as always, welcome.
Thank you very much for the introduction, and thank you for hosting us again. It's a pleasure to be back. We'll launch right into it. We've got a lot of different aspects to cover here in the macro world. There are lots of cross currents and developments to cover. So we'll start with China. That's been something that we focused on in our previous call with CAPIS, and our view at the time was that we were quite negative on China. We had a longstanding negative view on Chinese assets based on the idea that the Biden administration would be basically carrying forward the Trump administration's grand campaign to counter China's ambitions across a number of different fronts, be those technology, economics, investment, geostrategic, and so forth, trade, obviously. But with a different set of priorities and obviously a different kind of approach with a focus on multilateral, which wasn't emphasized obviously as much under the Trump administration. Our sense was that there would be really no political benefit to the Biden administration easing up on China, and we've certainly seen the GOP ready to pounce on any sign that the Biden administration is giving an inch, and so the Biden administration has really not. That they've certainly followed the script that we thought, and emphasizing human rights to a great degree, pushing forward on some of the Commerce Department's blackballing. The process that the SEC and is undergoing in terms of the enhanced disclosure that will be required of U.S. listed Chinese companies, that is in train, and we don't expect that to be watered down meaningfully. That's obviously not shock therapy, but we think that will be a headwind to Chinese assets. This was before we even saw the shift in the wholesale shift from Beijing into a into a regulatory campaign against their own private sector. We felt that that Xi Jinping was certainly not the economic reformist type in the way that the Western conception may have, very early in his tenure, may have characterized him. He's proven himself to be quite the opposite, and the very high profile, the willingness to take extremely high profile measures against some of the crown jewels of the Chinese economy is proof positive that that they are not constrained by concerns, that the stocks will drop for these companies, and that it may be over the long term deleterious to the economic vitality of the private sector. That doesn't seem to be working necessarily into the equation here. We think that the common prosperity theme will continue, and that the Chinese government will take greater control over data, over payments, the digital renminbi as a competitor rather than a complement in a lot of cases to some of these payment platforms that had grown up in the private sector. And this is what we see going forward. What's the next? They've gone through so many. The question is, which industry's next? They've hit so many already that certainly the theme of common prosperity when it comes to like private healthcare and some of these other companies, that's probably certainly it. But we want to step back and say that this is not a straight line kind of event, and this is a process, and we think it has ebbs and flows. And our expectation had been that common prosperity would remain very much in the rhetoric and front and center in the Xi Jinping platform ahead of the National Party Congress next year in October, but that the sort of harder edge of it would begin to ease back a little bit, and the unwillingness of Chinese, the central bank and other authorities to let credit run up a little bit would also wane somehow early next year, to allow markets and the economy to gently accelerate into October at a time when the political winds will be blowing very hard through Beijing, and it's as though from the outside looking in, it looks like Xi Jinping has monolithic control over everything. That's certainly not what we hear from inside people that are in the know and more connected on the ground. There's still a lot of horse trading to be done, and even someone like President Xi, who has a lot of legitimacy outside of the economic realm, will want the economy to not be making a lot of waves, and so we expect this to motivate an easing off of some of the worst restrictions early next year. Now, of course, two of the things that we think really accelerated that process of easing are the Evergrande really circling the drain here, and certainly the energy crisis. Evergrande, the requirements from the policymaker side are protect the retail investors in the wealth management products, and try to somehow complete the enormous number of apartments and properties that have yet to be delivered by this company. And this is a loss spreading exercise, but the prioritized, but the resources will be prioritized to these retail and home purchasers, and that is in keeping with Beijing's need to quell any sort of public unrest over this issue, and also they want to try to cauterize it. We've obviously seen some smaller developers going under. This is not a great environment. Home prices are deteriorating and sales are down. So it is a challenging time for developers broadly. We think Beijing will attempt to turn this into a loss spreading exercise and try to seclude some of the other players in the market from this. Evergrande really distinguished themselves with a lot of leverage, and so we expect the Chinese government to be successful in doing this. At the same time, they're working. They're working to. We think that Beijing is focusing also on this energy crisis, the push toward trying to get to the root of the problem with coal supply, that's what they're going to try to feed into the bottom of this power and manufacturing chain. And if they loosen up the log jam in coal, then presumably that will, it will flow through the entire system, and easing up on emissions requirements and that sort of thing. This is not an immediate fix by any stretch of the imagination, and we think that both the property headwinds and the power problems will create economic difficulties and headwinds over the next couple of quarters. But our expectation is that Beijing fights this off sufficiently to avoid any systemic shakes in the market. So our view on China, Chinese assets and equities have performed very badly. We don't necessarily have a call from here that they're going to continue to plummet or that we're going into a Lehman Brothers moment. That's not our call. Our call is more like dead money. This is an economy that's challenging. It's probably going to come out the other side early next year, looking a little bit better, and that's certainly in keeping with the political requirements of Beijing. But it's not going to be a very pretty process. We're watching the renminbi. It's been strong and steady and that's reassuring to us. It's actually been stronger than we thought, and so that's maybe Beijing sending a message that all is well, and so we're watching the currency and certainly the broader credit markets for tells on that front. But we wouldn't say at this point we're positive on China, but we certainly don't. Our base case is not a systemic implosion and a dramatic collapse in the economy. It's muddling through, and it doesn't look particularly pretty. Switching over to inflation, supply lines, and the Fed. I'm going to kick it over to Brendan to talk about the inflation picture and the Fed outlook.
Yeah, definitely. So obviously the minutes were very enlightening, and we've had a kind of a long-standing call that they probably hold off in December, especially after the latest jobs report. I think it's a little bit more academic at this point. The market is fine with November or December, so I'm not sure it's entirely market moving. But I do think they're confident enough in their outlook to begin the taper process. It also helps that the Treasury issuance is going to fall off a cliff basically right now because we're kind of running up to all the pandemic spending. So the amount of Treasury issuance that the Treasury has to go forward for the next year is a lot less. So the timing of that does coincide well for the Fed, where even though they're reducing their purchases, they'll still be buying a significant amount of the new issuance. Now I think that the conversation has flipped to when the first hikes should be, and that debate is very little around growth outlook and much more around the transitory nature of the inflation outlook. The Fed is still confident, the core of the Fed is still confident in this being transitory, but every month it's looking a little less and less transitory. But it's also clear that this inflation is driven by supply chain constraints and not necessarily a situation like the 70s where you're having hyperinflation. So that puts them in a little tough spot where prices are going up, and we're seeing it now that earnings season has started. Every day, more and more of the companies are citing that they both their costs have gone up, and also that they're able to pass it on to the consumers. It's not everything, like at a grocery store, 95% of the things are still flat or at normal price increases, but it's making headlines, and on the prices of things that are going up, it is starting to eat into maybe the consumer mentality. So I guess the problem with the situation that they're in is we can't ship things, so you can't produce enough of them. So that is resulting in prices going up. If you raised rates, you would also make it more difficult on the companies to expand their workforce to fix the constraint problems. So it's not a normal Fed inflation scenario. It's, I suppose we did go through it in 1919, but the world was a very different place. So the solution to this inflation problem is different than it's ever been before. And some are calling for us to tighten. Tightening would work, but it would probably result in maybe a recession. Leaving it alone might help, but it also could result in significantly higher prices going forward. So I think the Fed is in a bit of a Goldilocks scenario here, where I think the market's going to let them taper here at the end of the year and probably, knock on wood, not have a tantrum. But as months go by and prices still remain elevated, their credibility on the transitory nature is going to be pressed. And we also are in a situation where the Biden administration has to make a choice on who's going to be the next Fed president. There's indications that they would like to keep Powell, but they haven't said anything yet, at a point where they really should. We're getting down to the wire in terms of the time when it needs to be decided.
Yeah, we have a long-standing out of consensus call that Powell is not renominated, and it goes to Governor Brainerd. That is obviously, that we recognize that this is a pretty close call. And as Brendan said, the Biden administration has a lot to worry about, and a confirmation fight for Lael Brainerd going into the seat wouldn't necessarily be the easiest.
Right,
because cakewalk.
Yeah, because Powell would be approved with 70, 75 votes. It wouldn't be hard. Anybody other than Powell will be a partisan vote that will be tight.
Yeah, and there's a sense that the Biden administration has to make a decision now. Well, we've seen the Biden administration make a lot of late decisions on personnel, and so it wouldn't be
a huge amount of spots that still aren't filled, very important spots.
Yeah, and so there may be a sense that the Biden administration they've got a lot going on, and there's a Fed meeting coming up in early November, and it's, as Brendan said, the distinction maybe is a little academic whether it's November or December, but November gives them the opportunity to, if they don't taper and they say, hey, we're going to wait until December, and we're on track to taper by the end of the year, but we're going to give it another month, look at the data. That would be a signal to the markets that they are still very much in the transitory camp, and that the core of the Fed is really still holding on to that.
That would be led by Powell, who, if you're applying for a job, that's a good way to keep to indicate to the guy that's going to hire you that I'm not a true Republican anymore. I'm going to stay dovish on this one.
Yeah. But there is, this being Washington, D.C., we're a D.C.-based outfit. And this being D.C., everything is colored in the lens of politics. And President Trump made no bones about it. He wanted his people who saw the world his way on the Fed. And when you look at the Fed board, it is extremely, it's very tilted toward Republican nominees. And so we think that the winds will blow toward the Biden administration, not obviously saying that so overtly, but making that choice. But we admit that it's a close call. And so, our expectation is that on the other side of this inflationary, that it is much of what we are seeing is transitory. Inflation has hung around way longer than we expected. You can transpose the word inflation and the pandemic right there. And I think that link is very important. The reason that we've got so many of the problems that we have is probably because the public health outcomes that we were all expecting in June have, not materialized in a significant way.
The opposite. We had the biggest wave that we've had so far.
And everybody is, absolutely exhausted and dispirited by this latest Delta wave. But we are on the other side of it in important ways. And so our expectation for the end of this year and early next is that the public health situation does end up looking better. That a lot of good things flow from that. There's continued or a rebound in confidence, and some of the worst of the bottlenecks begin to get begin to get sorted out as the public health picture improves. And that leads us to another part of our expectation, another plank in our base case, that the Biden administration is successful in passing the double barrel, the bipartisan and a reconciliation infrastructure bill, and calling a truce between the two wings of the party that are obviously appear to be entrenched, but are inching toward some sort of compromise.
Yeah.
Some sort of
And I think this week has been a big breakthrough, because before, too much of the narrative was around the dollar amount of it, and that's not really what the argument is over. It's what those dollars are spent on. So no one's saying it has to be 1.5 or 2. The point is, the difference between 2 and 3.5 is a lot of very progressive spending programs. So now the hard choices and debates are going on within the Democratic Party of, do we cut this out or do we shrink everything? And very specific conversations are being had on that front. And I think that's a good sign.
Yeah, and this, not to circle back to the Fed, but this is one of the reasons we think that the odds are in favor of Brainerd over Powell, not just because of the stock trading stuff and the noise around that, which obviously we don't think helps his candidacy. But
no, she was actually in charge of the. That supervision was under her control, so she is dinged by that also a little bit. But the media hasn't really gotten there yet, so I think she might be safe on.
But the obviously what we're seeing is Manchin and Sinema are dragging the party over to their viewpoints, and Manchin is a very tough nut to crack. Obviously, Sinema is as well. We've had a long-standing view that the tax issues, that the tax proposals from the Biden administration would be watered down significantly. But we didn't expect, for instance, Senator Manchin to take quite as hard a stance as he is on climate stuff.
Right.
And so this is where the liberal wing of the party is going to be asked to swallow a lot of the compromise here. They're going to have to give way more ground than Manchin and Sinema are willing to give. And one of the things that the White House can give them is Brainerd as the Fed chair. And that's, it's not a costless exercise, but we think that this formulation tips the scales in her favor. But it's not as though it's the end of the road for a lot of these proposals. We think, what we end up with is the bipartisan bill, and then a, 1 point, finger in the wind, 1.7, 1.5
somewhere between
to
1.5
2,
and 2.
Yeah,
exactly.
1.5 to 2 trillion reconciliation bill. This is going to be spun as a, the media is going to try to spin this as a huge loss for the Biden administration, when actually it's not it's not really going to be. These are really huge numbers and consequential programs.
But it also should be pointed out that this is spent over the course of 10 years. So
yeah, this isn't a
$200 billion or so a year. And actually, a lot of these programs, especially the infrastructure side, we don't have the ability to implement them right away, so it might be much more back-ended. It's
not a shot of adrenaline into the economy like the COVID relief checks were. No question about it. And execution, we can talk a little bit about that going forward, but execution, particularly in the infrastructure space, has been a problem in the U.S., and it's something that the White House is obviously looking to fix. But on the other side of this, we think that the debt ceiling increase goes into the reconciliation bill, and they get this thing over the line. And the stuff that falls off the back of the truck, the social programs and that sort of thing. And one of the points that Brendan has made a lot is you don't have to have, if you cut down the size of some of the social programs and put them in the bill, that's all you need. That's the foot in the door. And then those programs just grow over time. But that's certainly.
We've literally never cut a social, safety net program ever.
Right, so, it's pretty hard to cut. But the stuff that falls off the back of the truck is going to go into the Democrats' 2022 midterm platform. Right. The American Families Plan, which we've all forgotten about, is a multi-trillion-dollar, strictly social and government services and benefits program package. And everything that falls off the back of this will go right into that and will form the basis of the sort of pan-democratic election platform, vote for us, and here's what you get.
Yeah. And a big reason why we've always kind of thought this was going to happen, not that we've been confident it's going to happen, is things are not looking good for the Democrats before, even when things were going well, when we were entering the summer and it looked like things were fine, and before Afghanistan and for a lot of other things, the Democrats needed the midterm elections were going to be difficult, and they were probably at least going to lose the House. If they don't pass this, they have nothing to run on. So you're guaranteed to lose the midterm. You lose both houses. So it could be a bloodbath. And I don't know, most politicians have a instinctual self-survival gene.
Right. Well, yeah, the Democrats have to fight hard for their positions before they give them up. That's just the rule for Capitol Hill.
Exactly.
And we think that the liberal wing will fight hard, but then eventually capitulate, and we'll get two bills that are a much smaller headline number, and then it'll be the two sides trying to spin it as a spin their outcome.
Yeah, and then they hit the campaign trail.
Right.
Yeah.
Yep.
Criticize each other.
One of the other things that's really weighing on if there's one thing you can say about the Biden administration, maybe this sort of parade of horribles that has hit them right now with the Delta wave, Afghanistan, the party infighting over infrastructure, so on and so forth. It's better that this is happening now than next summer. Maybe. Yeah,
you'd rather. Yeah.
That's you'd rather get beaten up. You'd rather get beaten up like this, and we all hope that the public health outcomes, at the very least, are.
And that's one thing that the Biden administration has done a great job on a lot of things, but they have done a very good job on logistically distributing vaccines, which is, if you had to choose one to not screw up, that would be the one.
Right. And the news about therapeutics, we've talked with our friend, Dr. Chris Morris, who's a virologist at George Washington University. He's been an excellent resource for us. And it was one of our early warning signals back in early 2020.
Early February, yeah.
Yeah, and so, but he's very excited about the possibility of therapeutics coming in. This Merck trial was very encouraging, and will be part of what brings us into the endemic phase, where COVID isn't as front and center in our day-to-day lives as it has been for the past year.
And now we have the plan for the boosters and the approval, and also the approval for for kids, and a plan also to start that in a couple of weeks.
Yep. And the energy, this is another in the parade of horribles for the Biden administration right now. It's the oil price spike. And boy, OPEC didn't do them any favors. And they sent National Security Advisor Sullivan over to Saudi Arabia ahead of that meeting. That was, as the White House spokesperson said, oil prices were on the agenda, and OPEC came out and didn't do anything to increase their pace of rolling back the supply cuts that they instituted to support prices. The cartel is pretty mercurial. They surprised us by being so confrontational, and basically, Beijing to Brussels to Washington, basically throwing in their faces in early October and saying, "Nah, we're good with our current roll-off program." And we think that may be a less of a durable position and more of a demonstration effect. But it falls short of a prediction in saying that if oil prices are knocking on the door of $90 a barrel, they're not far off now. Yeah, this is the kind of OPEC showed what they can do in October. They don't have to demonstrate their power anymore. They can do the world a solid in November. These are monthly decisions that they're making, and certainly I think the case can be made that they stuck it to the world for a month in the revenge of the carbon crew, but come November they may show some inclination to ease off, and super high oil prices, which is something that is figuring in people's possible risk scenarios going forward, not something that OPEC wants. Oil price spikes are deleterious to their future as well. And so you want to have oil prices high, but not too high. And we think that they are crossing over. at the threshold, but we're getting to the point where OPEC, even OPEC themselves, may not be comfortable with, a persistent, 90s and marching higher into threatening 100. So.
Yeah. John, we have a question. So regarding China, you mentioned she is not having the degree of monolithic power that people view as having. Who are the other important figures in the Chinese party to look for? Comments, posturing statements, et cetera, as it pertains to financial markets?
That's a really good question. I think the ups and downs and who is basically the who's ahead and who's behind. And we certainly expect President Xi to get a third term. We don't think that there will be enough upheaval or enough turnover in the ranks that actually gets him into that knocks him off the box. But the Shanghai faction has not gone away, and there's lots of dissatisfaction among very powerful people, and so really if you go through and look at the various permutations of who might be where and the names of the various candidates for these Politburo seats, really the big split. What you have to watch is just how high up and just how pervasive. It's really a numbers game. How high up and how pervasive within the incoming ranks are any non-Xi affiliated politicians, and they would tend to be the Shanghai faction. And I think that is the idea that his monolithic that his control is being eroded would really come down to that. How many loyalists is he able to get onto the Politburo? And that, I think that's the expectation is that he runs the table again, and we think that's probably right, but he's not going to take any chances. So we think that he's firmly in control. We think that he's going to have no alternates creeping up the ranks behind him, and but he's not going to take any chances in the lead up to that, and that's what we think feeds into the rising credit numbers, the improved, the easing off of some of the harder edge of the common prosperity stuff. If you want to, so the actual names, if we want to go through those, that's something we would love to talk offline about. So.
Yeah, we're on a Zoom call, so.
I just got a question handed to me here from one of my guys on the floor, and it has to do with the COVID-related shots in the arm that the economy got. Can we expect any more going ahead, or because we had COVID-related direct payments, would future administrations, including Biden, be more inclined to provide those to the consumer?
Absolutely. I think from a policy perspective, this was the direct payments were Trump, they were Biden. These are this is a bipartisan. This is a very bipartisan thing at this point. Looking back at the depths of the crisis, the Republicans right now say this was these kind of direct payments are they're socialism and that sort of stuff. Well, wait until if a Republican takes the White House again, and that kind of narrative will shift.
Yeah.
That's politics.
No, and also within financial markets, we can argue whether the debt that we built that spent that was worth it, and the long-term consequences. But what is clear is if you hand people money, they're better off, and the economy ends up being better off, and recessions can be a lot shorter. So I agree that when you're in charge and you go into a recession, you're going to look back on this experience and use it to follow. And
so when basically just to roll back the tape on the deficit stuff, right? So the Democrats that we talked to during the Trump administration basically looked at the Trump tax cuts and said, look, we've seen this again. every time we have a Democrat in the White House, we have the Tea Party militating to, have fiscal stricture. And, the Clinton administration really internalized that. The Obama administration, some of it was forced on them, but that was a very fiscally contractionary,
It really was. Yeah.
very fiscally contractionary period during the Obama administration. And the Democrats and then the Republicans get in, and it's not spending, it's through tax cuts that blow out the deficit and the debt. And the Democrats say, we're the chumps at the table. That's the message that we heard during the Trump years. Every time the Republicans get power, they spend like crazy and, in their own way. And we're just not going to play this game anymore. We've tried to be, fiscal rectitude and on all that stuff. And Larry Summers is still kind of in that camp. And it's not a total, it's not a totally one-sided consensus. But the idea was basically, look, we've got to start playing this game too, and we've got to have faith and put money behind our ideas. And the Republicans right now, like they kind of rummaged around in their closet to find the Tea Party uniforms to sort of get up the debt and deficit stuff, but that really hasn't risen to the top. Inflation is the push point that they're talking about. And so when it comes to the idea that deficits, Reagan proved deficits don't matter, is the Republican talking point that emerges when there's a Republican in the White House. It's a very cynical debate, and there's really no constituency that we can see that's meaningful, that is rattling on about cutting back government, that is about cutting the deficit, taming the deficit, that sort of stuff. And I think that, we're in a situation where whichever party comes in 2024, we're going to see the very same kind of fiscal profligacy. And whether that has an inflationary dynamic, sting to the tail, and we're going to find out.
Yeah.
Okay, we have another question. Yeah, I see that there. You want to take it, Brendan?
No, you can.
Sure. A question here we have from the viewing audience. Given all the energy themes that you've mentioned and their connection to the overall prospects of moving away from fossil fuels, how have you seen the ESG investing trend manifesting itself in DC conversations?
Yeah, I mean, I think that ESG is something that DC, if you're on the Democrat side of the aisle, it is, it aligns very easily with your policy program, your worldview, that sort of thing. It's about trying to redefine what is value, and the value and the risks and costs that, as we, the sort of traditional way that they're measured, don't take into account the damage to the environment and long-term risks and that sort of thing. And ESG is an imperfect but better capture of the real sort of societal value that got left out of the typical sort of corporate and business valuation metrics and judgments and modeling. And so on the Republican side of the aisle, it tends to focus. I don't think it's a wholesale. It's like a wholesale rubbishing of the entire category. But the Republicans will point out that there's a lot of baloney in ESG, and they'll rightly point out there's a lot of baloney in ESG. It's a very squishy standard. There aren't a lot of,
we actually don't have a standard.
Right. That's right.
Yeah. So
fragmented.
and we're taking a punt on it. So the Europeans are working on creating a EU-based standard of what qualifies as a ESG. We're probably still a year or two away from that being. And in terms of policymaking circles here in DC, we've decided we're just going to follow what the Europeans do. So from a political perspective, it's actually a really easy one. You can be pro ESG because it doesn't really mean anything yet. You can, other than like if you're drilling oil in the middle of the sea, you can qualify pretty much anything as an ESG project.
it's a slippery standard. And I think that there's,
today at the FSOC meeting, for the first time, they are bringing up environmental standards and banks, which when you talk about a slippery slope, that's a little dangerous. If you put higher capital charges on a bank if they make a loan to an energy or company or things like that. So we're still in the very, very early innings of that. But for the first time, the regulator is kind of looking at an ESG related climate change as it relates to the banking industry.
Yeah, and I think that it's totally understandable and a valid criticism for the right wing and sort of the carbon crew, as I characterize them before lumping them all together, to say, hey, the transition to clean energy, fine, all well and good, but if you accelerate it too fast, you outrun the coverage and you end up with carbon, insufficient investment in carbon. You have basically you get beyond the capabilities of green and sustainable energy to deliver the kinds of power needs that are that these economies require, and they're not ready for prime time yet in the way that carbon is.
There's a lot of stuff that goes into a battery. It's not that easy to make them. And so you can't just transition overnight, even though consumer that really likes it. But one good example is California is outlawing motorized leaf blowers, and that's a very good idea. Like gas powered farm, lawn care, it's terrible for the environment. So it's a good idea. But on the flip side, next year, if you're a team of 5 that's doing landscaping, you would need somewhere between 80 to 90 fully charged batteries for a 1 day of work. And we don't have that many batteries right now. So you have to have a transition.
Yeah, it's a very challenging position for policymakers to be in, and certainly the carbon industry is basically saying, hey, look what you did to us. This is our fault. And there's a point to be made there.
Yeah, it's not looking like a fun winter in Europe. So
and part of it is the fault of I don't want to get too far into the weeds here, but policymakers can't level with the American people about the costs of these programs.
Right.
To sit there and say, like, to be Jimmy Carter and get on and I say, you're going to turn down the heat, put on a sweater, and man up. And some of the communications from the White House about supply bottlenecks and stuff have kind of veered into that lane a little bit, into quit your whining, we've all got to pitch in. That's just not the way that politics works these days. There was a time and a place maybe where that would resonate, but not now. And it really opened you up to an enormous, and it has opened up the White House to criticism on that front. So
definitely a great call, guys. Some great topics here. I don't have any more questions in the queue. So with that, we will bring our call to a close, concluding our call now. We'd like to thank again, on behalf of the CAPIS family, John and Brendan of Market Policy Partners, for participating and sharing their great insights. Dynamic speakers. Thanks, guys. Our next CAPIS research call will be on November 18th, and it will feature Nick Colas of DataTrek. So please stay tuned. Keep up with us also on social media. We have LinkedIn, Twitter, and the new CAPIS YouTube channel, where you'll find this broadcast as well. On behalf of the CAPIS family and Markets Policy Partners, thank you so much for watching, and have a great day.
And
Thanks,
we're
guys.
also always happy to do follow-up, either emails or questions. And, we also offer trial periods. So reach out to the CAPIS or our website, and we're available.
Yep, marketspolicy.com.
There you go, guys. Take care.